It looked like the end. Silver didn't fall to $73.72 on Tuesday because the supply deficit suddenly vanished. It didn't drop 13% in a week because solar factories stopped buying. It didn't get crushed because the world decided silver isn't worth anything anymore. And it didn't break down because the long-term story changed. Silver fell to $73.70 because of fear. A stronger dollar, a stuck situation with Iran, a hot inflation number that scared people out of the market. That's it. Those are the reasons. And here's the part almost nobody is saying out loud. Every single one of those reasons is temporary. None of them touch the actual supply and demand for physical silver. The metal in the vaults didn't change. The deficit didn't change. The factories that need silver didn't stop needing it. Only the price changed, and only because scared traders sold. Then something happened on Wednesday. Silver bounced. It hit $76.63 in the morning. It closed at $75.86. By Thursday, it was at $76.02. The flush to $73 held. The floor that everyone was watching, the floor that lines up with the highs from late 2025, did its job. And the question every serious silver investor is now asking is simple. Was that the bottom? Was the $73 flush the shakeout that clears the weak hands before the next move up? Welcome back to the Macro Mirror. In this breakdown, I'm going to walk you through exactly what caused the $73 flush, with the real numbers and the real reasons. I'm going to explain the difference between a real crash and a fake one, because understanding that difference is the whole game. I'm going to show you what happened the last time silver had a violent flush like this and held the floor. And I'm going to give you the 4 signals that will tell you whether $73 was the bottom or whether one more drop is coming first. Quick favor before we go further. Subscribe. If you want clean breakdowns when the market gets scary and everyone else is panicking, not hype, not cheerleading, just the mechanics, hit the bell. The best buying moments don't feel like buying moments. They feel like the worst possible time. Let's get into it. Let me start with what actually happened this week. Because the story the headlines told and the story the data tells are two different things. On Tuesday morning, silver fell below $75 in early trading. By the close, it was at $73.70. That was a drop of more than 13% from the previous Wednesday's close. From its all-time high of 121.62 set back on January 29th, silver was now down more than 37%. On the surface, that looks like a market falling apart. A metal in serious trouble, a bubble that popped and kept popping. But look at what caused it. There were 3 reasons, and all 3 are about fear, not fundamentals. Reason 1, the dollar got stronger. When the US dollar rises, anything priced in dollars, including silver, tends to fall simply because it takes fewer dollars to buy the same ounce. This is mechanical. It has nothing to do with whether silver is scarce or in demand. It's just currency math. Reason 2, the situation with Iran got worse, not better. There was hope earlier in the week that tensions would ease. Then the reality of a more entrenched conflict set in. That kind of uncertainty pushes investors toward the dollar and away from assets they perceive as risky in the short term, even assets like silver that historically do well during conflict. Reason 3, inflation came in hot. April CPI printed at 3.8%, above what forecasters expected. Normally, hot inflation is good for silver, but in the short term, hot inflation made the market believe the Federal Reserve won't cut interest rates anytime soon. Higher rates for longer makes non-yielding assets like silver less attractive in the immediate term, so traders sold. Notice what's missing from those 3 reasons. Nothing about supply, nothing about demand, nothing about the deficit, nothing about how much silver is actually left in the vaults. The flush to $73 was entirely about macro fear and currency moves. The physical reality of silver, the part that actually determines its long-term value, didn't change at all. So here's the first lesson. There are 2 kinds of price drops. There's a real crash where the fundamentals break, supply floods the market, demand collapses, the reason to own the thing disappears. And there's a false crash where scared money sells for reasons that have nothing to do with the underlying value. The $73 flush has every fingerprint of a false crash. Fear-driven, macro-driven, positioning-driven, not fundamentals-driven. Let me get more concrete about why this matters. Because false crash sounds like a comforting story bulls tell themselves. So let me show you the actual mechanics that prove it. Picture a fund manager at a mid-sized commodity trading firm. Tuesday morning, May 19th, 2026, 8:15 a.m. He's watching silver fall below $75 on his screen. He runs what's called a momentum strategy. His computer models automatically sell when prices break key technical levels and buy when they break higher. His model just hit a sell trigger as silver broke below $75. The computer starts selling automatically. He doesn't make a decision. The algorithm does. It's selling because the price is falling, and the price is falling partly because algorithms like his are selling. It's a loop. He's not selling because he thinks silver is finished. He's selling because his risk system told him to reduce exposure when volatility spiked and the price broke support. Across the market, dozens of other funds are running similar models. They're all selling at the same time for the same mechanical reason. None of them are making a judgment about silver's long-term value. They're just following their risk rules. Now picture a different person, a physical silver dealer in Texas, same Tuesday morning. His phone starts ringing at 9 a.m. Customers want to buy. The paper price just dropped to $73, and his customers see a discount. But here's what he tells them. His premium, the markup over the spot price, hasn't dropped. If anything, it's gone up because demand for physical coins and bars just spiked. He's selling American Silver Eagles faster than he was last week. The paper price fell, the physical demand rose. Those two things moving in opposite directions is the clearest possible sign of a false crash. By Wednesday morning, the algorithmic selling had exhausted itself. The funds that were going to sell had sold, and with the weak hands cleared out, the buyers stepped in. Silver bounced to $76.63. The floor at $73 held. The flush was over, at least for now. So here's the second lesson. A false crash happens when forced sellers and scared money dump an asset for reasons unrelated to its value, while the people who actually understand the value step in to buy the discount. The $73 flush had exactly that structure. Algorithms and frightened traders sold. Physical buyers and patient investors bought. When the sellers ran out, the price bounced. That's not the pattern of a dying market. That's the pattern of a shakeout. And here's how this connects to your everyday life. Because this isn't just a story about a trading screen. The same inflation that scared traders out of silver this week is the inflation you're feeling at the grocery store. Ground beef just hit $7 a pound for the first time in American history, up 77% since January 2020. The 30-year Treasury yield just crossed 5% for the first time since 2007, which means new mortgage rates are pushing above 7.5%. The cost of living is climbing faster than the official numbers admit. Here's the irony. The hot inflation number is exactly why silver sold off this week. Traders feared the Fed would stay tough, but that same inflation is the long-term reason to own silver in the first place. When your dollars buy less beef, less gas, and less house every year, you want to own things that hold their value as the dollar weakens. Silver has done that job for 5,000 years. The market sold silver this week because of inflation. The same inflation is the case for owning it. That contradiction is the false crash in a single sentence. Now let me show you what happened the last time silver had a flush exactly like this. Because we don't have to guess, we have the record. Go back to January 30th, 2026, just a few months ago. Silver crashed 33% in a single session from above $121 to $76. The cause? The CME raised margin requirements, which forced leveraged traders to sell whether they wanted to or not. It was a mechanical, forced selling event, not a fundamental one. The headlines screamed that the silver bubble had burst. Analysts called the top. And then what happened? Silver found its floor near $74 consolidated, and through February, March. In April, it traded in a range between $70 and $80. It didn't collapse to zero. It didn't go back to $30. It held. The structural floor held because the fundamentals never broke. Now go back further to 2011. Silver ran to nearly $50, then crashed hard on a series of margin hikes. 5 increases in 9 days. Forced selling, mechanical, not fundamental. The difference in 2011 was the environment. The Federal Reserve was tightening. Real interest rates were rising. The money printing from the 2008 crisis was being unwound. Silver's tailwinds weren't pausing. They were gone. And so that crash was real. Silver fell from $50 to under $15 over the following years. Here's the critical difference, and it's the whole point. The January 2026 crash had the same mechanical fingerprints as 2011. Margin hikes, forced liquidations, paper silver sold faster than physical buyers could absorb. The mechanism was identical. But the environment was the opposite. In 2026, the supply deficit is structural and in its 6th year. Industrial demand from solar, EVs, and AI hardware keeps growing. Physical inventories have been drained. The Fed has not pivoted to the kind of positive real rates that historically end precious metals bull markets. Same crash mechanism, completely different environment. And the environment is what determines whether a crash is real or false. The 2011 crash was real because the tailwinds were gone. The 2026 flush is false because the tailwinds are still here. Peter Schiff put the broader picture simply in a recent interview. A bond market crash is the most bullish thing that can happen for precious metals. Traders just haven't figured that out yet. The 30-year Treasury crossing 5% is exactly the bond market stress Schiff is describing. The traders selling silver this week haven't connected those dots yet. The ones who do are buying the discount. Let me give you the bear case fairly, because if I only told you the bullish side, I wouldn't be doing my job. The bear case is real and worth taking seriously. The $73 level is support, but if it breaks on a weekly close, the next real floor is much lower. Some technical analysts point to $55, which lines up with the 200-day moving average as the next major support. One widely followed market commentary noted that a close below $72 leaves little meaningful support until much lower. That's a real risk. If the dollar keeps rising and the Fed stays hawkish, silver could test the high 60s or even the $55 area before finding a durable bottom. The bears also point to real demand risks. UBS recently cut its year-end silver target to $80, citing concerns that a slowing economy could hurt industrial demand. Bart Mellick at TD Securities has the most bearish forecast on the analyst panel at $44.25 for 2026. And there's genuine substitution risk. Solar manufacturers are working on using less silver per panel, and some new battery technologies don't need silver at all. These are honest arguments. They might be right in the short term. Silver is volatile, and a false crash can still get more painful before it reverses. Being right about the long-term direction doesn't protect you from short-term drops. But here's what the bear case doesn't explain. If silver is genuinely finished, why are physical dealers raising premiums while the paper price falls? Why is the Shanghai market still paying above the global benchmark? Why are vaults still draining? If Bart Mellick is right about $44 silver, he needs to explain why the physical market is acting like silver is scarce while the paper market acts like it's worthless. The structural data doesn't support the deep bear case. It supports a volatile floor with strong fundamentals underneath. So ask yourself, when silver flushed to $73 on fear and bounced the very next day, when the physical market kept paying premiums while the paper price fell, when the supply deficit is in its 6th year, when the same crash mechanism from 2011 is happening in the opposite environment, and when the inflation that scared traders out is the exact reason to own silver, what does the $73 flush actually represent? The end of the story or the shakeout before the next chapter? Now let's read the current action like a detective reading clues. The clues all point the same direction. Silver bounced off $73 within a single session. Fast bounces off support suggest buyers were waiting, not absent. The RSI, a measure of whether something is oversold, hit deeply oversold levels during the flush, which historically precedes bounces, not further collapse. Physical premiums held firm or rose while the paper price fell, the cleanest sign that real demand is intact. Trading volume on the down days was driven by forced algorithmic selling, not by long-term holders dumping their positions. And the floor at $73 lines up exactly with the highs from late 2025. Old resistance becoming new support is one of the most reliable patterns in markets. You'd also expect, if this were a real crash, for the institutional bulls to give up. They haven't. Bank of America's bull case is still $135 to $309. Citi's targets are still $150 to $170. The structural analysts who track physical flows haven't changed their view. The selling was concentrated in paper futures. The conviction stayed in physical and in the institutions that understand the deficit. So here's the cliffhanger. The $73 flush held. The bounce came fast. The physical market never flinched. The fundamentals never broke. Everything points to a false crash, a shakeout, not a breakdown. But silver is volatile, and the bears have a real argument that $73 could break and lead to a deeper test. The question isn't whether the fundamentals are intact. They are. The question is whether $73 was the final bottom, or whether one more flush comes before the real move up begins. Now let me put the bigger picture around it, because silver doesn't move alone. Gold is near $4,794. Central banks keep buying gold at record pace. The Federal Reserve just had its most divided vote in 50 years. 8 members against 4 on the last decision. Kevin Warsh just became Fed chair on a party line vote, the first ever. The 30-year Treasury is above 5%. Inflation is at 3.8%. The government deficit is over $2 trillion, and ground beef is at $7. Every one of these forces points toward a weaker dollar over time, and a weaker dollar is the long-term engine that drives silver higher. Here are the 4 signals that matter more than any scary headline you'll read this week. 1. The $73 level on a weekly close. This is the cleanest signal. If silver closes the week above $73, the floor is holding and the false crash thesis is intact. If it closes below $73 for 2 straight weeks, the bears are winning and a deeper test toward the high 60s becomes likely. Watch the Friday closes, not the daily noise. 2. Physical dealer premiums. This is the signal you can check yourself this week without any special tools. Walk into a coin shop or check 3 online dealers. If the premium overspot on Silver Eagles is holding or rising, while the paper price is flat or falling, the physical market is telling you the metal is still wanted. If premiums collapse, the bears are right. 3. The dollar index. The strong dollar is the main thing pushing silver down right now. If the dollar weakens, even a little, the pressure comes off silver immediately. Watch for the dollar index to roll over. That's the trigger that lets silver follow its fundamentals higher. 4. The bounce follow-through. The Wednesday bounce to $76 was step 1. Watch whether silver can build on it. If silver reclaims $80 within a few weeks, the flush is confirmed as a shakeout. If the bounce fails and silver rolls back toward $73, the market needs more time. Now, I'm going to ask you 2 questions, and I want your honest answer in the comments. First, pick a silver price for August 31, 2026. Commit to a specific number. 85, 100, 120. Or do you think the bears win and silver breaks $73 and heads towards 60? Drop your number. Drop your reasoning. Don't hedge. Second, of the 4 signals, the $73 weekly close, physical premiums, the dollar index, or the bounce follow-through, which one do you trust most to tell you whether the false crash thesis is right? This question matters because the answer tells you what to actually watch over the next few weeks, instead of reacting to every scary headline. Now, what should you expect next? Expect more volatility. False crashes don't resolve into smooth recoveries. Silver could test $73 again. It could even briefly break it on a bad headline before reversing. Don't confuse a retest with a breakdown. The two look the same in the moment and feel completely different in hindsight. Expect the headlines to stay negative. The financial press doesn't call bottoms in real time. They'll keep describing silver as a broken trade right up until the moment it's clearly recovered. By the time the headlines turn positive, the discount will be gone. And expect the hardest part to be psychological. Buying when everyone is scared feels wrong. The January 2026 bottom near $74 felt like a disaster while it was happening. The 2020 bottom felt like the end of the world. Every real buying opportunity in silver's history has felt exactly like this, like the worst possible time. The investors who do well are the ones who watch the fundamentals instead of their own fear. I'm not telling you what to buy. This is education, not personal financial advice. Your situation is your situation. But I'm telling you what the $73 flush actually was. Silver fell to $73.70 on Tuesday because of a strong dollar, an Iran stalemate, and a hot inflation number. All temporary, all macro, none of them touching the physical supply and demand. It bounced to $76 the next day. The floor held. Physical premiums stayed firm. The deficit is in its 6th year. The same crash mechanism from 2011 is playing out in the opposite environment. Amateurs watch the price and panic. Pros watch the fundamentals and the premiums and ask one question: did anything real actually change? The amateur tape says silver crashed. The professional tape says silver got shaken, not broken. Silver has been money for 5,000 years. It has survived every false crash in its history, and there have been many. The 1974 dip that scared people out before the run to $50. The 2008 collapse to $9 before the run to $49. The January 2026 flush to $74 before the recovery. Each one felt like the end. Each one was a shakeout. The pattern repeats because human fear repeats. So here's the clean summary. Silver flushed to $73.70 on Tuesday, down 13% in a week and 37% from the January high. The cause was a strong dollar, an Iran stalemate, and a hot 3.8% inflation print. All temporary, all macro. It bounced to $76 the next day. Physical premiums held. The $73 floor lines up with late 2025 highs. The supply deficit is in its 6th year. Bank of America's bull case is still $135 to $39. The 2011 crash was real because the tailwinds were gone. The 2026 flush is false because the tailwinds are still here. This is where the serious holders of silver separate from the tourists. The tourists watch the price and run. The serious holders watch the fundamentals and ask what really changed. If you want the next breakdown, the moment $73 either holds or breaks, the moment the dollar rolls over, the moment the bounce confirms or fails, subscribe. These shifts don't announce themselves on the channels that are paid to keep you looking the other way. Hit the bell so you catch the move before the headlines do. Drop your August 31 silver target in the comments. Tell me which signal you'd watch most closely, and I'll see you in the next one.